Travel Visa Tales, where we embark on captivating journeys around the world. If you find our videos inspiring, be sure to show your support by liking, subscribing, and sharing our channel. Understanding common loan policies in the USA for citizens. Loans play a significant role in the financial lives of many Americans. Whether it's buying a home, funding education, or starting a business, loans provide the necessary financial support. However, to ensure a fair and transparent lending process, the United States has established several common loan policies that borrowers and lenders alike must adhere to. Interest rates. Interest rates are at the heart of loan policies in the USA. These rates can be fixed or variable and depend on several factors, including the type of loan, the borrower's creditworthiness, and prevailing market conditions. Federal and state regulations often set limits on interest rates for specific loan types, ensuring that borrowers are not subjected to exorbitant charges. Credit score requirements. In the USA, lenders use credit scores to assess a borrower's creditworthiness. Different loan types may have specific credit score requirements, and borrowers with higher credit scores are more likely to secure loans with favorable terms. Loan policies specify the minimum credit score needed for approval. Loan-to-value (LTV) ratio. For loans involving assets such as homes or vehicles, loan policies often set maximum loan-to-value (LTV) ratios. The LTV ratio compares the loan amount to the appraised value of the asset being financed. Lower LTV ratios are preferred by lenders as they represent less risk. For example, a mortgage with a lower LTV ratio typically requires a larger down payment, reducing the lender's exposure. Loan origination fees. Loan origination fees are costs associated with processing a loan application. These fees can vary among lenders and loan types. Loan policies may specify the maximum origination fees that can be charged, ensuring transparency in the loan origination process. Borrowers should review the terms and conditions to understand any fees associated with their loans. Loan term. The loan term is the duration of the loan, which can vary widely. For instance, mortgages may have terms of 15 years, 30 years, or other options, while personal loans typically range from 1 to 5 years. Loan policies dictate the allowable terms for each loan type, and borrowers must choose a term that aligns with their financial goals and capacity for repayment. Payment schedule. Loan policies also outline the payment schedule, including the frequency of payments and the due dates. Some loans may offer flexible payment options to accommodate borrowers' needs. It's essential for borrowers to understand their payment schedule to avoid late fees and penalties. Prepayment penalties. Certain loans may include prepayment penalties, which are fees charged to borrowers who pay off their loans before the specified term. However, many states have regulations limiting or prohibiting these penalties. Borrowers should inquire about prepayment penalties when considering a loan and factor them into their decision-making process. Regulatory compliance. Lenders must comply with federal and state regulations governing lending practices. These regulations are in place to protect borrowers from unfair or predatory lending practices. Common regulations include the Truth in Lending Act, TILA, and the Equal Credit Opportunity Act, ECOA, which promote transparency and fair lending practices. In conclusion, understanding common loan policies in the USA is essential for borrowers to make informed decisions and protect their financial well-being. Whether you're considering a mortgage, an auto loan, or a personal loan, being aware of these policies empowers you to navigate the lending landscape with confidence and secure loans that align with your financial goals and capabilities.